This video offers a brief introduction to inheritance tax, or IHT as it's commonly called. I'll look at what is inheritance tax, how is it calculated, why clients should think about it sooner rather than later. Then we'll have a very brief look at exemptions and reliefs, and I'll finish up with a 6-step plan on solutions to help you mitigate it. But we'll start by quoting Lord Jenkins back in 1986, and I agree with him that inheritance tax is currently a voluntary levy. But clients do need advice on how best to deal with this. And I'll only quote one statistic. 530 million is the amount that was gifted to HMRC last year. And I say gifted because this could have been avoided, as this amount comes from whole-of-life policies which were not placed under trust. That means that the sums assured were liable to 40% IHT when the life assured died. Anyway, let's start at the very beginning with what is inheritance tax. The first mistake that a lot of people make is they assume IHT only applies on death, when in actual fact it is a tax on the transfer of value during lifetime or on death. And the value of that transfer is based on the loss to the estate principle, which may not necessarily be the same as the value of the article transferred. Let's look at an example. I own a pair of vases, and as a pair they're valued at £200,000. I wish. If I'm dusting the mantelpiece one day and I accidentally knock one off and it smashes into 1,000 pieces, I now own just one vase. And as a single vase, it is valued at just 50,000. So roll the clock back, and instead of knocking it off the mantelpiece, I very carefully lift it off and give it to my daughter. So I now own one vase worth 50,000, and my daughter now owns the other vase worth 50,000. But this morning, I had assets worth 200,000. So using the loss to my estate principle on gifting one vase to my daughter, the value of that gift for IHT purposes is not 50,000, it's actually 150,000. So how is IHT calculated? Assuming you're domiciled in the UK, that is, you see the UK as your permanent home, then you need to total your worldwide assets. That means all your assets, irrespective of where they are situated. And you need to include any gifts that you have made in the last 7 years. You also need to include any trusts you have created in the last 7 years. This will give you the value of your total estate. You may wonder why I've mentioned 7 years. Well, any gift that you make, assuming it is not exempt, will remain in your estate for 7 complete years before it finally drops out of the IHT calculation. The next step is to deduct your nil rate band. The nil rate band is currently set at 325,000, and it will remain at this level until at least the 6th of April 2018. And this amount is taxed at 0%. Every individual is entitled to a nil rate band. This calculation will give you your taxable estate, which is then liable for IHT at 40%. So let's look at a calculation. Joan Smith died on the 6th of April this year. Her total estate was 875,000, and she thought she'd left it to her 3 children. However, when we do the calculation, it looks like this. The value of the estate, 875,000, less one nil rate band of 325,000, and that assumes there's no transferable nil rate band available, leaves a taxable estate of 550,000. The tax rate at 40% means the tax liability is 220,000. This means that from Joan's estate, HMRC get 220,000 and her 3 children get £218,333 each. The largest beneficiary is HMRC, not quite how Joan expected her estate to be distributed. So why should clients think about inheritance tax sooner rather than later? People often assume that they don't need to think about it until they're in their 80s or 90s. But for wealthy individuals, the sooner they start gifting, the greater the potential savings, as their nil-rate band renews every 7 years. Therefore, someone who starts gifting at age 50 could use up to 6 nil-rate bands by the time they get to age 86. There are various exemptions available, but you need to know they exist in order to make use of them. Where the spouses or civil partners are both domiciled in the UK, they have an unlimited interspousal exemption, both during lifetime and on death, so there's no IHT on these transfers. Every individual has an annual exemption of £3,000. It's not much, but it does reduce the inheritance tax liability, and it can remove these gifts from the 7-year clock. However, it is more or less a use it or lose it exemption, as you need to use the current year's first, and then if you have any of last year's exemption available, you can use it, but you can't go back more than 1 year. The small gifts exemption covers gifts up to £250 to any number of individuals each tax year, but you can't combine it with the annual exemption to give one individual £3,250. However, you could give every member of your family and your friends £250 each year. Where someone has left their estate planning to the point where they do not think they'll survive 7 years, this may be a useful way to reduce the ultimate liability. Normal expenditure out of income is a very valuable exemption because there is no upper limit. You just need to show that you have income which is surplus to your ongoing requirements on a regular basis without reducing your standard of living. For example, someone who earns around £45,000 per annum income and has expenditure of around £40,000 per annum could gift round about £5,000 per annum, and that is exempt from day one. And don't forget, there is a special exemption for gifts on marriage or civil partnership. £5,000 from each parent to the bride or groom, £2,500 from each grandparent, and £1,000 from any other person. And the marriage exemption can be combined with the annual exemption, allowing, for example, a grandparent to gift up to £8,500 to their grandchild, exempt from day one, assuming they have this year's and last year's annual exemptions available. There are also tax reliefs available for business property relief, either at 50% or 100%, but strict conditions do apply, so if you think you may qualify, check it out. Likewise, there is also agricultural property relief, again at either 50% or 100%, but do check you meet the criteria. I'll finish this brief introduction with a 6-step plan. Step 1 is to make a will and to ensure it is kept up to date on a regular basis. If you don't have one when you die, your estate will be distributed under the laws of intestacy, and that may not be how you expect or want your estate to be distributed. Step 2. For married couples or civil partnerships, make use of your nil rate band on a first death rather than leaving a transferable nil rate band to your spouse. You could include a discretionary trust in your will, and that would remove the future growth on those funds from your spouse's estate as well as the nil rate band amount. Step 3. Use available exemptions and reliefs. If you're able to get something out of your estate without any liability to IHT or having a 7-year clock ticking, then make use of it. Step 4. Set up discretionary trusts. These are also called chargeable lifetime transfers. Step 5. Make gifts. This could be gifting that vase or a cash lump sum or any other asset, and it also includes setting up absolute trusts. These are all called potentially exempt transfers, and both have to run for 7 years before they drop out of the calculation. And finally, step 6. If you've done all the gifting you want to do and you still have an IHT liability, you can insure the tax bill by taking out a whole of life policy. But do remember to put it under a trust so that you don't add to that 530 million gifted to HMRC last year. I hope you found our introduction to inheritance tax useful. If you have any queries, please don't hesitate to get in touch.